Good afternoon and welcome to today's Keeping It Simple webinar. My name is Phil Dugan. I am joined today, as always, by Mike Green and Harley Bassman. Today's webinar is with Andy Constan and Cem Karsan to debate market structure. Today, Andy is the CEO and CIO of Damp Spring Advisors and has spent the past 35 years investing in trading global markets. Over the last 12 years, he has developed strong expertise in macro investing, working at Bridgewater Associates as an idea generator, and most recently, Brevin Howard as chief strategist. Cem Karsan is founder and senior managing partner at High Volatility Advisors. He is responsible for firm-wide management as well as being head of research and risk management. Gentlemen, welcome. Before we start, please note today's webinar is strictly for entertainment purposes, not to be considered investment advice. And for folks listening, please submit your questions to the Q&A queue as the chat has been disabled. Mike, take it away.
Thank you very much, Phil. So with a damp spring and a jelly croissant, this has to be for entertainment purposes as compared to something serious about investment. But very quickly, Harley, I get to watch the back and forth between Andy and Cem on Twitter all the time. And half the time I agree with one, half the time I agree with the other. That makes them both wrong half the time. But with that said,
isn't that better than your just ratio?
Go ahead, Harley.
Isn't that better than your ratio?
Yeah, no, my ratio is 100% wrong. So the half that I agree with them and the half that they agree with me is always wrong. It's a useful property to have. All right. So, but Andy and Cem, you guys have been going back and forth in Twitter debating what causes markets to move, both in the short term and in the long term. Andy, I would say you're kind of the old school, right? You're more about it's interest rates. It's what the Fed says. It's around expectations, around earnings. And Cem, you're kind of part of the new breed of, market structure guys who I tend to lean towards, of course, that highlight because of the increasing elasticity in markets and because of the importance of option flows and hedging in the aftermath of the Volcker rule, that the structure has been irrevocably changed. What did I miss? Let's start with Andy.
Well, I think you missed a lot in that.
Okay, good.
My background started with the stock market crash in 1987, where I was working at Salomon Brothers and went down to become the Salomon representative on the Brady Commission. And that's really where my understanding of markets was started. And the crash of 1987 had nothing to do with macro. It had everything to do with, the markets might have fallen, but the rapidity of it had everything to do with market mechanisms. And in particular, the market mechanism at the time was portfolio insurance, which is simply dynamic hedging of an options position. It's not really an option position. It's a replication of an option position, but absolutely that's been the case. And also then running global derivatives at Salomon Brothers, I've been an equity options guy for more of my career than anything else. And back in the mid 90s, it was clear that, we coded into our risk management systems on our derivatives desks what we called at the time D delta D time and D delta vol, which are charm and Vanna. Yep. And since the mid-90s, guys like us, Citadel had just been formed, Susquehanna, Blair Hull, who sold his business to Goldman, all of the major options market makers and upstairs firms were using these concepts for alpha. And so throughout my career, I've been 100% of the view that these flows matter. But as I've grown over the course of my career, what I would say is that everything matters. And so what you need is to have to compete in markets today, you need to have all of the table stakes. You can't enter markets with a short stack. And everything about market structure is part of the table stakes.
Okay. Andy, one second. Are you saying that the crash in 87 was caused by portfolio insurance? or that was a contributing, I mean, I'm thinking about direction versus speed. I mean, I think the speed was portfolio insurance, but I think the direction was caused by rates hitting 10%.
Sure.
I think wasn't that the driver?
Well, that's exactly the point, which is it's a combination of those things. But the crash itself from Friday, October 16th through middle of the week on the 19th, 20th, and so on, all the major dominant flows that caused 25% moves in the indexes were portfolio insurance flows.
But it would have gone down either way, though.
Not by that much, no way. If rogue algorithms, which were not suitable for trading in a period of time in which they had to move sizable market risk, regardless of price, were not in play, we wouldn't have had those types of moves. We may have gone down. By the way, just to put some meat on that, 1987, the year-over-year return from January to December was unchanged. So not even though there was this big macro thing, the levering up that portfolio insurance created in the summer and the deleveraging that it caused in the crash was a contributory force, and I think the dominant force for what happened in those few months.
So before we move on to Cem, because I want to get his response to what Andy is saying, but Andy, you hit on something I think in 1987 that a lot of people don't focus on. They focus on the crash, not the appreciation into it. How do you see portfolio insurance driving the price higher over the course of that summer? I'm not disagreeing. I'm actually interested in your point.
Right. So portfolio insurance behavior is you need insurance when the market's falling, and you don't need insurance when the market's rising. It's dynamic replication of a long put position that you're trying to do. And to do that, you need to sell when the market falls and buy when the market goes up. So if you instituted a portfolio insurance product in January of 87, you started with a negative delta. You had your portfolio, whatever you offer to your clients. In this case, it was the biggest pension fund in the world. Whatever you offer to your clients, you now have a S&P futures delta associated with it that is kept in a separate account, a short. As the market rose, that short got covered. And so that was a contributory flow on the way up. And then when it started falling, it was a the dominant flow because the fall came so quickly, and the flow itself caused the next leg down, that you got the quick unwind.
Got it. Okay, Cem, what's your reaction to that? Because it certainly sounds like a reasonable proposition. This is something that's been with us forever.
Yes, it's been with us forever in some form or another, and it is beyond, in my opinion, derivatives in their current form. It is market structure at its core. The world is long at scale. If you eat, sleep, breathe, you live in a home, you work a job, you're long. And so by definition, the tail and convexity in a market exists to the downside. And since the beginning of time, people have been trying to protect or insure against that devastating reality. And that creates market structure. That's where it all begins. And that's where everything comes from. In a sense, it's skew, right? It's convexity that really matters here. To back up a second, I want to be clear. And sorry, I'm battling a cold. So if I'm a little low energy today, I apologize.
You're so much higher energy than Jeb Bush. I'm not the least bit worried about it.
Totally. Let's not get into politics. It's going to get very, very difficult here. So Andy, who I have a deep regard for, I want to start out by saying that all of you here, I think very highly have a great respect for. And I don't see the world from 30,000 feet differently per se. I think it's when you kind of get closer down to the ground that you start to have differences, and it's about how we measure and the scale at which we value certain aspects, and how we model them and how we see their significance over different timelines. And I know that sounds kind of boring and not as exciting as throwing punches and saying, hey, he thinks about the world one way and I think about the world another way. Macro matters, the big picture matters, the weighing machine is always out there weighing on the long-term effects and where things will end up. The voting machine is a bit more complicated. And I think that's where where we talk about in the short term and over different, sometimes what does short term mean? Quarterly, monthly, daily, second, minute, hour, right? Over what time frames different things matter and to what extent. And I think that matters to a lot of people on here. That's what trading is about. When you're looking at monthly performance, that's what hedge fund, and regular fund performance is all about. So that's what we're really here to debate. And I want to be clear about that. Options, volatility, obviously the amount of volume, the amount of notional that's flowing through these products these days, has it increased meaningful different effect than it had maybe 10, 15, 20 years ago. But I'm here to tell you that when I started in the business in 98, that, again, not in 87, he's got a decade on me. But when I started in the business in 98, these flows were very much part of the market structure. We very much took advantage of these flows. They weren't as commonly understood or talked about. But part of the reason that we're so well versed in is because I was 13% of the volume in the S&P 500. We understood. I knew what dealer positioning looked like, and I understand the effects of it and the scale of it, right? And so I think that's not putting a resume up. It's just a different kind of experience, and that has been a major focus for me and what I've done for the last 25 years. Yes, interest rates matter. The cost of money matters. I would say those things matter over months, quarters, maybe even a year. But I think when we're talking day to day, week to week, even month to month on a little bit shorter time scale, these derivatives flows are significant, if not the majority often of the flows that push a market on a day-to-day basis. And Harley, it's not just about convexity. To Andy's point, I'll back up what he's saying here. It is about direction. It can be the reason that you go up or go down. Yes, the gamma effects, right, are critical to the convexity that comes out if there's short vol exposure. But there are multidimensional other exposures. Andy mentioned Vana and Charm, but there's VOMA and Veda, and all these other effects have significant effects on the day-to-day and the path, which is really what we're talking about here, of outcomes, and can significantly force outcomes over months, quarters, even years that may not have happened if that market structure was not in place.
So let's option flows, derivative flows can move markets significantly over long periods of time?
Over weeks, months, quarters, even years. Yes, it can take us on a path, and I've seen it happen. We could talk about 97, 98, 99, 2000, if you'd like. That is very out of line with the realities, and that's not the only effect there, right? But it is a major contributing factor. It can take us on a path that is irrational, completely out of line with the weighing machine or even the liquidity that might be in place during a time. It doesn't mean that we won't ultimately revert. It doesn't mean that things won't ultimately come back in line, but it does mean that we can go on a path, and that can be, again, years. I will stand by that.
One of the big things.
Mike's going to get there eventually. Mike will ask you at some point, I'll be curious, do you think zero-day options actually will move the market significantly off its path as opposed to local movements? Mike, I'll let you go run the show until we get there.
Well, that was one of the things that I was going to bring up, right? So one of the pictures that I would share if I'm pulling up is a very handsome picture of Andy and Cem. And then let's go to... I'm getting used to, unfortunately. Let's see here. Can we try this one more time here? Hold on. Canceled out of my slideshow. There we go. All right, let's do this one more time. Okay, so I mean, what Harley's referring to, and this is something that almost everybody knows, is that zero data expiry options as the percentage of total volume in options, for example, has just absolutely exploded. I would put this to both Andy and Cem and say, when you have something of this magnitude, right, this degree of change, how would you fit that into your respective points of view? Why don't we start with Cem, since Andy went first last time?
So 0 day, the result of the introduction of something is a function of the positioning, the positioning that exists, and the imbalance in positioning across different parties ultimately is what drives reflexive flows. And what do I mean by reflexive flows? If the people who need to hedge, who are not positioning as a one-sided longer term position that they're not going to move out of. The people who are hedging regularly, which are dealers broadly, have a certain position that's going to drive the probability and a path that is a function of the opposite positioning. When you take a product like 0DTE, it's a primarily a gamma product, right? So what is this going to exacerbate? It's going to either exacerbate big moves at periods or pinning of vol, on other periods, and it's going to do it on a very short dated basis. The more positioning you have in 0DTE, the more short-term volatility or pinning you're going to have. So this factor that's essentially it's not the vol of vol, right, is going to change on the short term. That little gamma piece is going to change incredibly quickly with more volume here. And that's what we saw. I think yesterday is a great example, right? How do you drop 80 points and then reverse 150 points in a day? This type of volume is a big contributor to that type of action intraday. And I think we will continue to see that as we go forward.
So I very much agree with that. Andy, what would your response be?
Yeah, I mean, I think it's obviously a product that's being used a lot and having impact on flows. The way I look at it for one, I don't really do things day to day, despite occasionally sending out funny memes on day trading. That's really not my business. But my view on an intraday is similar in that this is a pinning influence for small moves and an exacerbating influence on larger moves by and large. Like every setup every single day is not exactly the same, but by and large, that's how I'd characterize it, which I think Cem has said. The thing I'm more interested in is what Harley was pointing toward, which is this idea of, can it have a persistent effect? And I guess what I've observed, I'd be very interested in everyone's opinion on this, is if you have confidence that you are going to have the next morning, you're going to, and the following morning after that, and the following morning after that, you're going to have flows that are consistent with that thing that I just described, which is a pinning in low volatility environments and a negative gamma in others. You can anticipate that over time. So your 1 month option, your 1 month position has a different risk profile than it would have had if 0DTE didn't exist. And I think that's a powerful, longer term step back from the trees and look at the forest influence on these things, that locally it seems to be vol dampening, which is leveraging.
Correct. Yeah, that's exactly how I would describe it very quickly, Harley. Andy, I think that the way you're characterizing it is 100% right. It is a form of leverage, but interestingly, that leverage resets every day, right? So if I think about selling a 1 month option as a dealer, I now have something that I have to monitor and maintain and manage my delta against for an extended period of time. And it decays relatively slowly, right? If I have So if the market falls significantly, or even worse, let's go back to the sort of shenanigans people were doing in 2006 or 2007, where they were selling 10-year variance swaps or very long dated puts in various forms. Those types of contracts contribute on a continuous basis, basically meaning I'm always going to be paying out or receiving cash flows. They meaningfully actually affect the liquidity of the market. I kind of think of zero data expiry as like Russian roulette. It can hurt you, but it really can't hurt anybody else other than the emotional component associated with it. Does that feel right to you?
Well, again, I'm just focused on what the longer term implication is. And to me, if I can count on being able to know a certain flow is going to come every single day consistently, that may impact my willingness to hold risk over time. And so far, it seems to be that way.
So we saw an interesting example around this, Cem, and I want to come over to you on this because I think it was August 5th where we had the unwind of the dispersion trade, right? A lot of discussion around Japanese yen carry trade. I think you and I would both probably agree it had much more to do, at least what we saw in the US markets, had much more to do with the unwind of the dispersion trade, where people were short index options, long options on individual names. But one of the interesting impacts of that was actually that the zero data expiry option market didn't exist for about 3 hours, right? You couldn't get reasonable quotes on either side. Talk to what you saw on that day.
Yeah. So to your point, let's back up and talk about the dispersion trade and how that for the people listening that may not follow what actually kind of on the American side, what kind of kicked things off. And it was several days before, by the way. It didn't just start all of a sudden that day.
Right.
The decline in NVIDIA and the AI complex in particular, relative to the Russell, we saw it was 2 weeks before or so, we saw a 4 standard deviation.
About 3 weeks, yeah.
3 weeks before, we saw 4 standard deviation move in the rotation there. That was a function of massive call positioning in the Russell that was initiated by a couple of big names that you guys probably know. We don't have to name them. And a cascade that happened that created massive call positioning in the Russell. At the same time, we had been for about a week grinding sideways, and the calls that were primarily the major short positioning for dealers up until that point in the AI complex had started to decay and was forcing selling in those names. So you started to see a slow grind and a weakness that was turning in those names right as a bunch of call positioning and the call positioning became much more flattened there. And it drove a beginning of a massive, again, a dramatic rotation that once it took in, it really started to cause some pain and dispersion, and everybody had to get out. That pain ended up creating broader pain across the market. It started creating stress in portfolios and a deleveraging effect. That deleveraging effect was what eventually
5% intraday decline, right? Yeah. I mean,
now the interesting part that people haven't talked about is that now when you go to the index level, right, there was massive amounts of gamma supplied from the summer doldrums that we had in the August expirations on forward. There was for about a month of expirations had significant kind of vol and gamma supply. So the move that we saw was actually something we haven't seen historically in a major way. We saw a dramatic breakdown in several trades that we haven't seen in some time. Vega and skew exploded beyond a month, while the 1 month skew and vol actually was very well supplied. So you saw this really, really interesting move where it was a big gamma move in the market, but the gamma didn't react because everybody had the gamma. And there was a lot of pain in Vega land, dramatically so, that really pressured things on the downside. Part of the reason that it resolved so quickly and turned around is because the world was still, again, this is where path matters, really had the gamma. The gamma was there and entities were hedged. So as soon as the deleveraging happened, it was very easy for this move to turn around and turn around quickly. So that's kind of the timeline that we saw. Now, back to your question about zero DTE, The zero DTE part, even though the world was long gamma, call it 2-day, 1 day, all the way out to the power of 1 day was very important in this complex, because once the move started to happen, it's that supply is very fickle. That can change incredibly quickly. Last year at RMC, there were two big market makers up on stage on a panel. And I've talked about this before, but it's, I think, an important takeaway that everybody should understand. And there were a bunch of questions asked. And one of the last questions asked is, how the hell do you hedge zero DTE? You know what the market maker said? We hedge them with other zero DTE. Yeah. Unanimously, there is no hedging in any other products other than zero DTE, because you can't hedge something that is that short dated with anything but it itself. No, I think that's pretty much all you need to know about what this product's going to do. Unfortunately, Andy, I don't agree on this part. Like, I don't think you can rely on the fact that it's coming every day. That's the problem. It's fickle. It's fickle.
Right.
And at the end of the day, the vol, let me just finish here. The vol was incredible. The gamma was very well supplied there. And by the way, it was supplied at 2-day, 3-day, 5-day, 7-day, 10-day, all the way out. And then really it was 30 days SEP on out that really became, that was a major problem in terms of supply. But that 1 day has so much gamma in it. All it took was somebody lifting all that gamma, which happened pretty quick. And then everybody was stuck. And it was a cascade. And that's what a cascade looks like. And all the gamma that everybody had was gone. Because in a zero DTE, the amount of gamma is almost infinite, right? So.
Right, that's the point. Mike asked the longer term view on it. It doesn't mean that view is right, but I think it is having the effect of people being more comfortable. But that isn't a rational view. That's a view that has a tail, like you described. You can't count on it, but people are counting on it, would be my view.
Yeah, if they're counting on it, they're in trouble, And
right,
again, I think,
right.
Yeah, and I think
that's what I mean.
It creates situations like, this is an interesting point. Something I'm kind of digesting as we speak here, but it does create a situation where often you have a tremendous amount of gamma, you have you're hedged. And then that can change. The whole market structure can change in terms of gamma in particular very quickly, just because of the size and scale and convexity of the gamma at zero DTE and that market. There's just not enough liquidity to absorb it, really, because at the end of the day, if you can't hedge outside of this little market, right, then everybody's kind of stuck. Think of it as a GME, and it's kind of maybe a bad metaphor, but you can't hedge a GME with anything else, right? So if you have a buyer and it pushes, it just goes, right? We had a similar issue in some kind of regional banks. There's certain things you can't hedge except in the entity itself. You can't lay it off, and if you can't lay it off, that's generally a big problem for that active.
We circle back to this idea that Andy mentioned about persistent effect. Jim, if I told you that DTEs were going to go from 50-odd% to 60-odd% of volume, could you then say that there's going to be a systematic bias towards prices higher or lower? And I ask that because I'm not a believer in a persistent effect for this thing. And in the same way, in '87, when the whole thing was said and done, not only was stocks unchanged, but so were bonds. And this whole thing really happens because the whole core of Black-Scholes is that you can trade as much as you want at any price. And that clearly is not true. And that's why you had this massive movement in stocks on that day. But it wasn't persistent. It went away. So I'm asking you, do you actually think there's a persistent effect to this DTE, or actually to any of these delta, gamma, theta things you speak about?
I'll take this actually real quick. I think there's a persistent effect, but it's not in the way I think you're referring to it, Harley. It is not a persistent directional effect. It's not.
That's what I hear persistent.
About. Yeah. Well, hold on. Let me finish.
That wasn't. No, that's not my question.
It's not at its primary point a persistent directional effect, but it is a persistent effect that has a meaningful output and force that, given other effects, can lead to a persistent effect.
But if I'm investing over a reasonable horizon,
that may sound like a word salad to people, but I think it's important to understand.
Well, I don't think it does. And Harley, let me try this for just a second. What Cem and Andy are both describing is a situation in which people have become very comfortable with a form of insurance, that insurance will be there. right? And so just like in 1987, if I have confidence that I can ensure a single day event, a CPI print, a Fed report, a Powell speech, et cetera, that's going to make me feel less risk averse, right? And so the process of building up those exposures and believing that you can hedge at that very short dated horizon is unquestionably a bullish impulse. If everything else is going awry, that is not going to carry the day, but it is absolutely a bullish impulse to believe that there's a cheap and inexpensive form of insurance.
Right. Let me bring it to as simple terms as we could say. The Fed put, does that influence stock prices? Presumably it does. If the Fed is offering a put to the market, does that influence stock prices? I assume you'd say yes. Now the question is, if there is a cohort that is a reliable provider of insurance, increased insurance versus a prior period of time, and that cohort should have a similar impact to and doesn't hedge, and they themselves don't hedge. They provide insurance, and do not hedge that. That seems to me to be that removes some of the risk from owning stocks, and that's bullish.
Do you guys think that implied vols are generally higher or lower now because of DTEs?
Not my lane.
I would say in periods when they are lower, they are you have much more periods of market pinning, as we mentioned, where the gap between realized and implied can be much higher. But then you also have more convexity and more of a tail when things turn.
I haven't done enough of the study to prove this, but my intuition is that as it visually is if the distribution is of a certain shape without zero DTE, it has become one that has more density in the the -1 to +1% space, significantly less density in the 1 to 2% areas, and makes that up in the tails.
I mean, I got years on all you guys, and I'll tell you, my experience is that for liquid instruments, implied vol, 1 month implied vol trades 8 to 12% over realized vol forever, which is why people like Two Sigma or whatever else who sell the 1 month options that keep delta hedging at 4 o'clock, why they're billionaires, and the guys who buy the tails tend to not be billionaires. And if you look at the recent data, where we are right now, I mean, realized vol is like 15 for SPOOs. 1 month options trade around 15, and the VIX is trading at 18. So all's right in the world as far as I'm concerned. The move actually, rate vol is a little too high versus realized. The move is like 103 and the realized is 75, which is why I like mortgage-backed securities here. But I mean, I'm not terribly convinced. I'm New Chicago, man. So I tend to believe more in facts.
That ridiculous thing called efficient markets.
Yeah.
Like the point that I would actually make, Harley, and maybe mathematically this will help a little bit, and it may just confuse the hell out of people, right? What Cem and Andy were talking about before in terms of the market makers themselves hedging using these instruments. The availability of these instruments means they don't have to worry as much about the gamma increase, the change in delta that would occur from a move significantly lower. They're actually hedged themselves with a convex instrument. And so the net implication of that is almost exactly what Andy was describing, right? You basically enter into a distribution that is very dense between -1 and +1, or even, I would argue, even tighter, -0.5 to +0.5 is really where we tend to see it in the positive gamma environments. And then the tails show up in both directions, right? The other weird part, though, that ends up happening is where I would argue that, and this is part of my research around it, is that it also contributes to a drift, right? Because every day, if somebody is actually feeling more and more confident in the availability of that hedge, or using those hedges to either speculate or protect against their portfolios, the dealer activity on the other side of that hedging, and this is more true at longer dated, less true at shorter dated, But the dealer activity on the other side of that has its own continuous impact, right? And this is part of what Bouchaud's work around market impact shows, that less than half of that actually is unwound as you go forward. And so if there is a continuous stream of option selling activity, which is really the underlying characteristic that we've seen in this market, perversely, that actually causes the market to slowly grind higher in its underlying construction and hedging activity.
You know, guys, just an idea here. Going back 30 years ago, when all of us were trading with an abacus and a pair of dice.
He's not joking, by the way. Yeah.
Versus no, I'm seriously. I mean, it was sticks and stones.
I'm actually totally serious.
And
as well.
now we have
Let's remember the days when computing power was a limiting factor.
Now we have Susquehanna and Citadel running all these computers to go do all the trading for us. What impact does that have on the market? And number two is, I would link that also to Mike's whole passive narrative. That's changed also over the last 30 years, where it's become a dominant factor. Are we just dinosaurs, or is it all still just a slow advancement of civilization?
And before we jump to that, I want to share one more slide quickly, because this is actually the point of the next slide, which is this impact of changing market elasticity, which perversely has actually affected the largest stocks the most, right? And these also tend to be stocks in which single stock activity on options is fairly regular. Think about that in the context of the reply that you would give to Harley. Let's start with Andy.
Yeah, go ahead, Andy.
Okay, so the question is, has the going from a pit and specialist system to a electronic market making system had an impact on market pricing, liquidity, all of those things? And I would say, yeah, of course. The question is, at what what has occurred? I think the first thing is, it is simply positive. There is no net negative for having a more open, non-place, physical place or standing market for liquidity. And we can see that. We can see what competition has done in bringing transaction costs, bid offer spreads, which is only a tiny bit of transaction costs, down, commissions down to zero in most cases, et cetera. And that is just good. There's just no bad about that. The question that I think one has to ask about markets is it acceptable to have, is there enough requirement for market makers to continue to provide liquidity during stress environments? And I'm not sure yet. The jury's out for me on that. I don't think you can make any real conclusions about whether one system of market making is better in terms of its reliability for liquidity. I believe deep in my heart that the current system is way better than the past because it's deployed distributed capital. But I'm not certain that in fast markets that it's necessarily the case that, and you saw it on I tried to trade during August 5th and it was impossible. You couldn't trade during August 5th.
I have an interesting kind of, I think, addition to this. Obviously, Pitt and where we were with abacuses and dice, abacuses, I'm not sure. So is not, it's way more efficient now, right? But that assumes one very important thing, that volumes haven't increased, that we're not taking more risk. This is a risk constant, Yes, yeah, it's a safer, smarter market. But what happens inevitably when we think we have better tools and we are more in control? Well, we lever up risk, we lever up more volume, we lever up pressures in the system, and everybody, the system is dramatically bigger than it was 5 years ago, 10 years ago, 20 years ago. There's all kinds of new products and all kinds of new risks. And at the amount of leverage, the amount of activity in this space is being held together by this I won't say fallacy because it's not a fallacy. We are more efficient, but is that still as strong, or is that any better on the tail, right? Yeah, that's great with the markets kind of moving smoothly and without disjointed issues. But I've used this analogy in another context before. But if you have two entities, kind of two skinny little guys wrestling in a pit, like they may go nowhere. They may just push on each other and it doesn't go anywhere. But if you have two sumos and they're similar size, you'll have the same thing. But it doesn't mean the potential energy isn't bigger, right? I think there's dramatically more potential energy in this system, dramatically much more tail risk for all kinds of leptokurtic outcomes than there were 5 years ago, 10 years, definitely 20 years ago. And so I think in a sense, there's, again, this fallacy that we're in control, that we're smarter, that we know better, that all the entities out there are so efficient, so we can do all these things. But that leads to things breaking, not in small ways, but irreparably at times.
Yeah, I would echo some of what Cem is saying there. I think, it would be foolish not to argue that it is not more efficient and that we're not better served for the vast majority of events. In the same way, we are better served driving cars than we are using horses. But two horses colliding is a far less severe accident than two cars colliding. Two cars colliding is a far less severe accident than two planes colliding, et cetera, right? And so at every step in the process, we have to recognize that the potential risks on the tail events can be significantly larger. And probably I would argue that we have a higher standard of care associated with relying on some of these components.
I think that's a great metaphor. The one thing I would say is we're not dealing with gravity all the time, right? These things are not as consistent, right, as the laws of physics. And sometimes we think they are. And I think that's a problem.
I would argue that goes in both directions, right? And so we see this all the time where people are arguing this looks just like 1929, right? Or this looks just like 1987, et cetera. And one of the key points I think that Andy is bringing up, and I think Harley would emphasize this as well, is we may have had the downward direction in 1987, but any chart that includes 1987 is effectively picking out a path of potential outcomes that didn't have to happen. Right? I would argue the same thing. Like every time I go back and I look at the 2008, 2009 bear market, I just remind myself that there were really two very distinct phases to that. There was the pre-Lehman failure, and then there's the post-Lehman failure. And the aftermath of the Lehman failure, we didn't know how much cash people had, right? We legitimately did not know who was, how valid our counterparty agreements were, or the cash that we had held at Lehman Brothers International, if it still existed, right? We became unsecured creditors in the system in one form or another. And so I think that's really, really important. Same thing I would argue about Volmageddon, right? It didn't have to happen on that day. The dispersion unwind didn't have to happen on August 5th. It was helped by the volatility that Cem, I think, correctly points out, had begun basically a month before on the CPI print.
Mike, does passive touch this topic, or is it a separate topic entirely?
It does for two reasons, right? One is that my arguments around passive is that passive has actually created a market that has embedded convexity itself. And so the distribution that Andy was referring to, like what we actually see is that the distribution is increasingly skewed to the positive side, but very narrow in its underlying distribution under most days. In other words, calls are outperforming in a manner that should not make a ton of sense. There is an extraordinary premium associated with selling protection in the form of puts relative to selling calls, even as the skew in the market is near the lowest levels it's ever been in history, right, Cem?
Depending on where you're looking in the curve, things have gotten,
right, that's fair. But so I do think that this ultimately is influencing it. And I think, unfortunately, one of the things we may find is that if I'm right about my concerns, when that begins to unwind, the leverage that people have relied on and the patterns that people have relied on in their activities in these very levered areas could change in a meaningful way.
Gentlemen, do you think looking at the structure of the market or general stuff like this is an investment show? Is there any investment areas that you think are positively advantaged right now because of the structure of the market or anything?
Andy, why don't you take this one first, actually, because you've got some pretty strong views right now.
Yeah, I mean, I guess I'd start with what we've come off of and what we still have is an environment where assets are extremely well supported by existing liquidity in the market that was provided back in 2020 by spending and monetizing that spending with QE. And that money continues to flow through the market in a meaningful way and has kept asset prices, broadly speaking, asset prices very elevated relative to history. You look at any way of thinking about it, and people misunderstand me when I talk about this. I'm talking about the market portfolio, meaning everything you can buy in financial assets, from bills to bonds to tips to gold to crypto, equities, whatever it is. That portfolio has been well supported by very ample money in people's pockets that have been willing to take, and very easy leverage. And so for me, I look at the portfolio of assets, and has nothing to do with my near-term view, though I will tell you exactly how I'm positioned. I look at that and say there are very few environments where a full portfolio, a diversified portfolio, is going to meaningfully outperform cash, and more likely it's going to underperform cash in the next 12 months. And so my positioning is short 2-year bonds. Well, I happen to use SOFR futures for the people that are more sophisticated in the audience, which expect a 250 basis point cut in interest rates in the next 12 months. And I'm short that because I think the Fed, there are very few environments where the Fed will deliver that amount of cuts. Now, there are environments, let's be clear, there are environments where they will, and in fact do more. But those are called significant slowdown, financial breakage, recession, call it what you will, bad stuff for the economy. And then when you look out to longer term bonds, real interest rates are okay at around 1.6% for 10-year bond yields, for real bond yields. That's an okay rate relative to history. It's nothing to write home about. Inflation expectations are just at slightly below target. And so there's not a lot of juice to pay you in long-term bonds, except, as I said, these tail events. And then I look at stocks and say, when do you get paid in stocks? Well, you get paid in stocks when multiples expand, or when earnings beat expectations. And earnings beat expectations when the nominal GDP is high and rising relative to expectations. And you have multiple expansion when the Fed or the private sector, but it's most often the Fed, is cutting interest rates or providing liquidity at a rate, not what's priced in, but more than what's priced in. And so you notice equities do well in this very narrow window, and they have to beat 12% increases in earnings estimates, which is what we currently have, and a multiple that is already high. It's not all-time high, but it's high, to make money in equities. And to make money in bonds, you have to have a recession. And so you can't make money in both of those things. And so when I look at the opportunity in markets right now, I say the economy is likely to evolve too slow for equities and too hot for bonds. And so my positioning is short both of those things. And I have a beta portfolio, but my short in my alpha portfolio is equal and modestly larger than that. So I'm mostly in cash and own some puts.
Cem, what about you?
Yeah, so we kind of transferred from kind of the vol conversation to a bigger macro conversation, and I think timing matters. So, are we talking about how am I positioned for the next month, for the next 3 months? And maybe this is how we think about things different and process, right? Andy said before, he doesn't really position day to day. We definitely position day to day. We definitely position week to week. We definitely position month to month. So I think it's important to think about time frames. When we talk about when in terms of a bigger kind of weighing machine, I'm with Andy on a lot of these factors. I would actually be short something a little further out. So instead of the 2 year, I'd be looking at kind of 5 year or even further. That nuance is because we believe that the Fed stimulus that's likely to come into the market from that's already been priced in really is likely to, and the fiscal policy that will likely come after the election here as well will continue to support demand. We do think we'll get a recession, but we do think that recession will be very, very managed, and it'll be managed through fiscal policy and from a demand push as opposed to a supply side approach, which is what we're seeing for essentially 30, 40 years. I believe that will create a more stagflationary environment. That is core to my thesis. I think that's very bad for equities broadly. It puts the Fed in a box. That Fed put that we talked about earlier becomes less secure under that environment. I think inflation, even though the Fed will likely, I believe, be forced to actually follow through and make these cuts this time around. I've by the way, for years, kind of called the Fed's bluff on this, and again and again, it was transitory, right? And they pivoted, but this time around, I believe they are really going to lower interest rates. I think they will do what they are saying. The problem is I don't think that the 10-year will come down like we've seen in years past. I think we are going to see a steepener. I've been calling for this for a while. I think we're already seeing it to some extent. And so I do prefer to be short a little bit further out on the curve. And in terms of longer term positioning, I am also looking, importantly, I am not short this market. I am looking to get short this market. And I think that's a big distinction between what Andy and I are talking about.
Okay.
I'll add one more thing. We don't have to just position up and down, right? We have the beauty of volatility. And this to circle back to what we were talking about before. You can position for what looks like a big ramp up, a squeeze in a certain set of windows, and we can get into timing here a little bit if you'd like, but into the end of the year and early next year, and still benefit from long volatility. And that's really what we're trying to do at this point. We're trying to play this long volatility, risk protected, 1 foot by the door, and really looking to get some convexity on that final move and then convert that to short deltas and short convexity, long convexity on the downside as well. But that's broadly how we're playing this market right now.
Yeah, I just want to clarify I am also short long-term bond as well via puts. One thing to say, it's very important, and I think I think Twitter is an equity world, and so a lot of what you get in Twitter is what's your equity call. My positioning right now doesn't really care which happens. If I want to get paid, and if equity goes down, I'll get paid on my equity puts, and if bonds go down, I'll get paid on my bond puts, and my P&L won't care where it's coming from. What I think is that the combination of things has a high probability of success. Whereas if you told me you had only one position to be in equities and it had to be expressed in equities, it's unlikely I would have the same strategy and approach to investing if you limited me in that way.
So I just want to make sure, because that's a really good clarification there. Effectively, Andy, what you're saying, and Cem, you're echoing this a little bit, is that the level of interest rates reflects effectively a very weak economy. the level of equities represents a strong or at minimum soft landing economy. And so you're saying that the combination of those two is incoherent. So the joint probability of both going higher is low, is effectively what you're saying.
Right. I mean,
That's
both Jim and I are saying the same thing. We care about the distribution. I happen to be looking at a multi-asset distribution. And when you're looking at the equity and equity options related outcomes, you're looking at a equity distribution, but it's all about probability distributions.
Let me ask something over here. Seeing as this is an amazing time here because we have basically have the volatility mafia on one screen. Kind of exciting. The yield curve inverted a lot, and this really scrambles up forward prices. We're gonna get geeky again, guys. Really scrambles up forwards, which really screws up skew, as quoted in what's the costless risk reversal. How much of what you guys look at is damaged or scrambled up because of this curve inversion? And how much will things change when the curve steepens out? Because all these numbers will all kind of move around. Like it used to be, you do a 5% out of my call for 10% out of my put for zero cost. Now it's like 10 and 10. So skew measured that way looks flat, but it really isn't. So the work you guys do, how much of the curve impacts, the output of that?
I start with thinking not about the how to measure skew and how the interest rates are affected, but how interest rates affect the demand and supply of options. Like for instance, if you are going to market to a retail investor a call overwrite position, the attractiveness, the ability to market depends highly on the interest rate you're using, because the forward rate, the investor doesn't know a thing about. They don't know what that is.
Exactly.
And similarly, if you're looking at long-term bonds plus calls, which is a classic insurance policy structure, 10-year, 20-year receivers plus equity exposure plus puts, interest rates have a huge impact on how levered you can make that portfolio and how much upside with none of the downside you can offer to end clients. And so I start from there. The measurement issue, which is way too nerdy for the next 15 minutes or 3 minutes or whatever it is less of a problem. We have ways of futzing with that.
Yeah, I unfortunately have a hard stop in 3 minutes, but I would love to do this. There's actually a couple big topics we didn't even get to, so I'm always happy to do a spaces or hop back on. But the one thing I'll add to the interest rate comment too is, and I think this is a very astute point, is that interest rates coming down, ironically, we've talked about this as interest rates are higher, can actually help to ironically unpin vol and some of the effects we've had because structured product issuance has been so strong because interest rates have been so high. It's very counterintuitive to kind of historic precedent, but I think we could see a situation where structured product issuance dramatically reduces into significantly lower rates, and that could really have an effect on dampening the amount of vol supply, at least at 6 months, a year, or further out.
And just very quickly to explain why that is and then hand it off to Phil, effectively, when you look at something like a buffered product or you look at a product that has zero risk in terms of principal, what you're actually doing is buying effectively a zero coupon bond that is going to pay out at par and using the excess to buy an option in one form or another. If interest rates fall significantly, there's simply less premium available to engage in those types of trades. That's really kind of the easiest way to think about it. And the rapid shift has created conditions under which I would argue that people have been very aggressively seeking excess yield in various derivative products, even as they're largely ignoring a lot of the opportunity in fixed income. Harley highlighted mortgage-backed securities as a really interesting example where elevated volatility is influencing that sort of component. With that said, guys, it was fantastic. I'm totally disappointed. You were both gentlemen. You lived up to expectations in terms of thoughtful commentary. You disappointed terribly in your ability to tear each other down, presidential debate style. We're going to pass it off to Philip Dugan. Phil, take it away from here. Thank you again, guys.
Thanks, guys.
Yeah. Thanks, Mark. Thanks, Andy, Cem, Harley. That will conclude today's KS webinar. Please tune in for our next webinar, October 10th, where Mike and Harley will be checking in with Mark Blythe, professor of economics at Brown University. If you'd like to learn more about Simplify, please visit us at www.simplify.us. And with that, we will see you in October. Thanks, guys.